Many billionaire fund managers' market's attitude has shifted dramatically in early 2022. Many people have recently been positive on the market, which is absolutely contrary to popular belief. Warren Buffett, Charlie Munger, Bill Ackman, Jim Simons, Cathie and Chamath Palitiya, among others, have made significant investments in high-growth areas such as technology, innovation, e-commerce, and others in the previous 2 quarters. Certain fund managers, on the other hand, have remained cautious during this period. Managers like Michael Burry are standing firm in their opinion that a severe market meltdown is imminent. This begs the issue of whether global markets will begin to rise. In this video, we will go further into various fund managers' market outlooks and how these perspectives may affect the present climate. Welcome to Empire Investing, the channel for aspiring millionaires and billionaires. If this is your first time watching our channel, please consider subscribing to see more videos just like this. And with that, let's get started. Chamath Palitiya recently announced on the All In podcast that the S&P 500 index will fall again. Chamath predicted that large cap firms would suffer and that the S&P 500 would bottom around 3,800. The S&P 500 is hovering at 4,200 points, implying that the last plunge is not too far away. Buyers of growth equities are currently outnumbering sellers of value stocks in the market. The smart folks that I talk to, who I really look up to and respect, think that the bottom in the S&P is around 3,800 and that we will still need to do is this one last flush. And that last flush will really touch the big cap companies, but that growth is largely done sort of getting taken to the woodshed. So in general, I think that, so generally buyers are growth now, sellers are value, and waiting for this one last 400-point move down the S&P. And I think people think it's roughly the bottom. Now, if there's a world war, obviously, who knows? All bets are off, but Chamath Palitiya. David Sachs, a millionaire entrepreneur and world-class venture capital investor, backs up this claim. Sachs cited research that showed how the values of internet and SaaS firms have plummeted dramatically. EV revenue multiples increased throughout the 2-year COVID-19 period and then dropped to historical norms beginning in November 2021. There is a chance that this may continue to fall, but based on historical precedent, the bargain hunting time should begin now. Brad Gertzner has provided a few charts that show basically multiples in the Internet Index and among SaaS firms over the last dozen or so years. And what you can see is that spike over the last 2 years during COVID, there was a huge spike in multiples for internet companies and for SaaS companies, and that over the last, really since November, the last 3 to 4 months has now come down. And as of, I would say, last week, it was right about the historical trend, and now it's starting to go under the historical trend. So from a bargain hunting standpoint, you'd have to say that this is the first time that we've been below the average for a few years. Now, it's not to say it can't go down even more, because in the same way that you can be above trend, you can also be below trend. And if this war escalates and metastasizes, it will go down more. But if this conflict can't stay localized and the economy doesn't go into a recession because of everything that's happened, then yes, this might be bargain hunting. Brad Gertzner. Cathie Wood, CEO and CIO of ARK Invest, who returned 170% in 2020, definitely shares this opinion. ARK's ETFs witnessed significant profits from holdings in a variety of unsuccessful firms and cryptocurrencies. This was attributable in part to the underlying conditions of low interest rates and substantial stimulus. ARK's flagship innovation ETF, on the other hand, has recently been scrutinized heavily. The ETF is down 55% from its 52-week high and down 22% to date. ARK's investors are now confronted with a rising interest rate environment that is likely to be less tolerant of underperforming firms trading at greater valuations. Cathie, on the other hand, feels that higher treasury yields will have less of an impact on high-growth enterprises than on older corporations. Cathie's top 40 stock holdings have dropped by nearly 41% on average during the last 3 months. ARK's competitors, on the other hand, are only down about 14% during the same time period. This bigger drop can be linked to ARK Invest's preference for high-risk, high-growth, high-disruption stocks. Cathie Wood, who prefers firms that represent creative innovation, is unfazed by the dip. She argues that these losses are just transitory and that the bottom will be reached on January 27, 2022. Cathie also expects that the equities in the ETF will recover to previous levels and then continue to rise. Her optimism in the market's recovery is reflected in ARK's investments, which have recently been tilted towards specific high-growth companies. ARK's continued investment in disruptive startups reflects its investment approach, which focuses on companies with the greatest potential for transformation and innovation. Our companies are investing aggressively now because they see enormous opportunities, whether it's in the genomic space, the robotic space, energy storage, artificial intelligence, blockchain technology. And when you think about artificial intelligence, I think for us, and all we do is focus on innovation, the biggest surprise to us in the last 3 years is the amazing set of breakthroughs in artificial intelligence. We've got AI costs. Well, we've got AI moving more than twice as fast as Moore's Law, costs dropping 60% per year if you account for both the hardware and the software, Cathie would. To reflect their positive beliefs, other fund managers have invested in firms with significant growth prospects. Charlie Munger just doubled his bet and defended his stake in Alibaba. He claimed that the firm is a dominant force in Eastern e-commerce and cloud and that it is anticipated to develop significantly. Bill Ackman, who is normally wary of technology stocks due to their high valuations, bought Netflix early this year. Jim Simons, the CEO of Renaissance Technologies, one of the best-performing hedge funds in history, bid on two of the most well-known meme stocks in the fourth quarter, AMC and GameStop. These billionaire fund managers' different investments all have something in common. Their timing is also important in understanding these fund managers' activities. All of these investments were made in the fourth quarter of 2021 or the first quarter of 2022, demonstrating that fund managers are finding a lot of profitable chances in the present market forecast. Despite this, the anxiety surrounding Russia's incursions raises the issue of whether the market will be able to maintain some sort of stability in the face of the stress. The extraordinary sanctions imposed by numerous nations, notably the United States, have caused significant volatility and uncertainty in the stock market. The United States, in particular, the government has prioritized imposing financial sanctions on Russia, limiting trade and financial activities involving separatist Ukrainian territory, freezing assets of Russian state-owned financial institutions, freezing or rendering inaccessible overseas assets of Russian elites closed to Putin, and other financial measures are included. These sanctions have effectively triggered an economic war between the West and Russia. They have historically exclusively used these against hostile foreign governments such as Iran, North Korea, and Syria. The fundamental reason for this is to prevent Russia from gaining access to the majority of the considerable foreign exchange reserves and destroying their currency. As a result, Russia has lost access to global debt markets. These sanctions have an influence on the global economy as well. It raises the level of uncertainty in the market's outlook. This is on top of an already volatile market that is still reeling from the effects of COVID-19. As a result, risk premiums will rise across the board for various asset classes. Because the sanctions will damage Russia's energy industry, they will almost certainly have a strong inflationary impact. Russia is the world's third largest oil producer after only the United States and Saudi Arabia, therefore a significant amount of the world's oil supply has been impacted. This uncertainty has already been included into the price of oil, which has risen by around $20 per barrel in the last month. If the price of energy continues to rise, inflation will rise more. This is a cause for concern considering that we've already seen significant levels of inflation and supply chain concerns. The worst-case scenario would be excessive inflation and little economic growth, sometimes known as stagflation. Stagflation occurs when an economy faces high inflation while exhibiting little or no economic growth. That would be a dangerous situation since any attempt to control inflation would just further destabilize the economy. Furthermore, these sanctions placed further strain on the supply chain, resulting in higher food prices, higher flight expenses, and additional travel restrictions. Concerns have also been raised about interest rates, with Fed Chairman Jerome Powell suggesting that they are inclined to support a 25 basis point rate rise. He goes on to say that if inflation does not fall as quickly as planned, they will act more forcefully. Federal authorities claim to be startled by the duration of high inflation since they expected the pandemic's rapid price hikes to be transitory. Obviously, this has not been the case. The Fed's primary priority, though, remains on controlling excessive inflation. Powell has reiterated that the Ukraine situation will be considered when evaluating monetary policy measures, particularly should supply disruptions grow greater and longer lasting. There are numerous events yet to occur as a result of the Russia-Ukraine war, and there will be much instability in the future. However, these dynamics are not novel, and the COVID-19 pandemic has demonstrated that many businesses are robust and some may even be lucrative in difficult times. The actions of fund managers indicate that the global economy will most likely be able to endure such a catastrophe. However, there are certain exceptions in this mix. Michael Burry is one of them. Burry sold most of his U.S. equities late last year before any news about the Ukraine situation became available. This was in preparation for the quote-unquote mother of all crashes, as he refers to it. Burry was able to avoid stocks that had plummeted during the economic crash, such as Golden Ocean, Marinus Pharmaceuticals, and Scorpio Tankers. Since the third quarter of 2021, these three equities fell by 25%, 44%, and 43% respectively. Burry, on the other hand, lost out on cashing in on some of his higher valued assets such as Precision Drilling, Occidental Petroleum, and Inglis Markets. Since the second quarter of 2021, the three stocks have increased by 91%, 38%, and 26% respectively. Burry is only one of many fund managers, and furthermore, many billionaire fund managers are growing exponentially more positive on the market. However, there are certain problems that are already affecting the market and may continue to affect global economies as time goes on. This raises the question of whether the markets are bullish or bearish. Despite the market's present volatility, billionaire fund managers are prepared to withstand the next storm. In fact, many of them feel that this is the moment to go stock hunting and cherry-pick the stocks that will truly be winners. That's all for today. Where do you think the market is headed and your thoughts on the fund managers' positions? Join the discussion in the comments below. And if you like the video, please click the like and subscribe button. We'll see you guys in the next video.